Welcome to LuckScout Economic News. The United States economy is navigating a complex landscape influenced by Federal Reserve policies, a surge in oil prices, shifting labor market dynamics, and a slowdown in the service sector. Each of these elements shapes the economic environment, influencing inflation rates and consumer spending. Recently, the Federal Reserve has adjusted its policies in response to inflation concerns, impacting various economic sectors. Oil prices have increased sharply, affecting transportation and manufacturing costs. The labor market shows mixed signals with robust job creation in some sectors, while others face layoffs. The service sector, a reliable growth engine, is experiencing a noticeable deceleration. In this essay, we will explore these critical economic developments in detail and propose strategic responses. The Federal Reserve's role in economic stabilization is crucial. Recently, the Fed has been adjusting interest rates to keep inflation in check without stifling growth. These decisions influence interest rates charged by banks, impacting everything from mortgage rates to business financing. When the Federal Reserve increases interest rates, the goal is to cool down an overheating economy by reducing spending and borrowing. However, these changes can also lead to reduced consumer spending and slowed business investment. Conversely, lowering interest rates aims to stimulate the economy by making borrowing cheaper. The recent hikes in interest rates have been a response to persistent inflation pressures. While necessary, these increases can lead to higher loan costs, potentially slowing down sectors like real estate. Understanding these dynamics is crucial for investors and policymakers alike. A significant surge in oil prices has captured attention due to geopolitical tensions, production cuts, and recovering global demand post-pandemic. High oil prices affect the economy by increasing transportation costs and influencing the prices of petroleum-based products. Airlines face higher fuel costs, leading to increased ticket prices, affecting travel and tourism. Manufacturing costs rise, leading to higher consumer prices and contributing to overall inflation. The surge in oil prices can lead to greater investment in alternative energy sources, accelerating the shift towards renewable energy. However, the benefits of high oil prices are not evenly distributed. Energy companies may profit, while consumers face higher costs. This disparity can lead to economic imbalances, where the energy sector thrives at the expense of broader economic hardship. Policymakers must navigate these dynamics carefully to mitigate adverse effects. The United States labor market has shown resilience and complexity. Sectors like technology and healthcare show strong job growth, while retail and hospitality are still recovering from the pandemic. Job creation in high-growth sectors reduces unemployment and boosts consumer spending. However, many jobs in technology require specific skills, excluding a significant portion of the workforce. This disparity can exacerbate income inequality. The labor market's health is a critical determinant of Federal Reserve policy decisions. Strong employment numbers can signal a healthy economy, but may lead to wage inflation, prompting the Fed to tighten monetary policy. Conversely, signs of weakness could lead the Fed to adopt more stimulatory policies. The service sector, encompassing industries from hospitality to financial services, has been experiencing a slowdown. This deceleration is due to reduced consumer spending, ongoing pandemic adjustments, and sector-specific challenges. The slowdown is concerning because it employs a large portion of the workforce and significantly contributes to GDP. As inflation rises, individuals become more cautious about spending on non-essential services. This reduction in demand affects service industries, leading to lower revenues and potential job cuts. The lingering effects of the pandemic continue to impact sectors like tourism and real estate. The slowdown can lead to a broader economic contraction if not addressed. Businesses are turning to technology to enhance efficiency and create new value propositions. While challenging, the slowdown encourages businesses to rethink strategies and adapt to changing conditions. Understanding the interrelation of economic indicators is crucial for comprehending the overall economic picture. These elements are interconnected and can amplify or mitigate each other's impacts. For instance, an increase in oil prices can lead to higher transportation and production costs, slowing down the service sector. Federal Reserve policies designed to control inflation by adjusting interest rates can have widespread effects. Higher interest rates can make borrowing more expensive, slowing down investment in sectors like real estate. The labor market plays a significant role in this interplay. A strong labor market can bolster consumer confidence and spending, driving growth in the service sector. Understanding these dynamics helps in forecasting economic trends and making informed decisions. In a fluctuating economic environment, crafting effective investment strategies is crucial. Given the current landscape, diversification and risk management become paramount. Diversification across asset classes helps mitigate risk by spreading investments across sectors and geographies. Real estate and commodities are traditionally seen as good hedges against inflation. Real estate properties often appreciate in value and provide rental income, while commodities like gold and oil typically increase in value during inflation. Investing in these assets can protect against the eroding effects of inflation. Focusing on sectors less sensitive to economic cycles, like utilities and consumer staples, can provide stability. The use of options and futures can manage risks associated with economic fluctuations. These financial instruments allow investors to hedge against potential losses in their portfolios. Inflation can erode purchasing power and destabilize economic systems. In times of rising inflation, investors often turn to real estate and commodities as protective measures. Real estate benefits from inflation as property values and rents typically increase with the cost of living. Commodities like gold, silver, and oil are viewed as safe havens during inflation. Investing in commodities can be done directly or indirectly, providing flexibility in strategies. However, investing in real estate and commodities involves risks. Real estate markets can be affected by local economic conditions, interest rates, and tax laws. Commodities can be highly volatile and influenced by global factors. A tailored approach ensures investments are protective against inflation and positioned for growth. Treasury inflation-protected securities, TIPS, and short-term bonds are critical tools for managing inflation risk. TIPS are designed to protect against inflation, with the principal value rising with the consumer price index. Investing in TIPS is appealing during periods of expected high inflation. Short-term bonds offer advantages like less sensitivity to interest rate changes and liquidity. In an environment where the Federal Reserve is adjusting rates, short-term bonds can offer a safer bet. The combination of TIPS and short-term bonds provides a balanced approach to managing inflation and interest rate risk. TIPS offer protection against inflation, while short-term bonds provide stability and liquidity. Understanding how TIPS and short-term bonds react to changes in inflation and interest rates is vital. This knowledge helps optimize investment strategies for capital preservation and growth. High dividend stocks and international diversification are pivotal strategies for growth and stability. High dividend stocks from resilient sectors provide regular income streams, serving as a buffer against market volatility. These dividends offer potential for capital appreciation and certainty of payouts. On the global front, international diversification enhances portfolio performance by tapping into growth opportunities in different economic cycles. This reduces risk as the portfolio is not tied to a single country's economic conditions. International markets may offer unique opportunities in sectors not prevalent in the U.S. However, international investing comes with challenges like political risk and currency fluctuations. Effective international diversification requires understanding these risks and managing them. Combining high dividend stocks with international diversification offers a balanced approach for robust portfolio performance. In conclusion, the current economic environment presents both challenges and opportunities for investors. Navigating this landscape requires a keen understanding of how these factors interrelate and influence the economy. By staying informed and adapting strategies, investors can position themselves effectively. Economic vigilance is key to making informed decisions and achieving financial goals. Please like the video and share it with others. Thank you for watching.